Something extraordinary is unfolding in the silver market right now, and if you're holding physical silver, you need to understand exactly what's happening, because what we're witnessing isn't just another price spike. This is different. This is structural, and the implications are massive. Let me show you what I mean. Silver has surged over 80% this year, blowing past $50 per ounce and hitting levels we haven't seen in decades. But here's what most people are missing. This isn't about speculation. This isn't retail investors piling in. This is about something far more fundamental happening in the physical market itself. The squeeze everyone's been talking about for years? It's actually happening. And the evidence is everywhere once you know where to look. Start with the supply side. Global silver production has been essentially flat for years, hovering around 800 million ounces annually. Meanwhile, demand has been exploding. Industrial applications alone consumed over 600 million ounces last year. Solar panels, electronics, electric vehicles, 5G infrastructure. Every major technology trend of our time requires silver. And not just a little bit. We're talking about fundamental, irreplaceable industrial demand. But here's where it gets interesting. Investment demand has surged simultaneously. Physical silver purchases through ETFs, coins, and bars have added another massive layer of buying pressure. When you combine industrial demand that can't be reduced with investment demand that's accelerating, you create a perfect storm in a market that's already tight. Now layer in what's happening with mining. Silver production isn't easy to ramp up. Most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. You can't just decide to mine more silver when prices rise. The supply response is slow, constrained, and limited. And many of the world's largest silver deposits are in politically unstable regions or facing environmental restrictions that make expansion difficult. The math is brutal. We're consuming more silver than we're producing. The deficit has been growing year after year. And unlike gold, silver gets consumed. It's used up in industrial applications. Once it's in a solar panel or an electronic circuit board, it's effectively gone from the market. The above-ground stockpiles that could buffer supply shortages, they're being drawn down at an alarming rate. Think about what this means. Every year we're eating into existing inventories to meet demand, and those inventories aren't infinite. At some point, the physical metal simply isn't available at current prices. That's not speculation. That's arithmetic. But the real story is playing out in the futures market, and this is where things get fascinating. The COMEX, the major exchange where silver futures trade, has been showing signs of stress. The ratio of paper silver claims to physical silver available for delivery has been widening. There are far more contracts representing silver than there is actual metal in the warehouses to back them up. Now, most of the time, this works fine. Most futures contracts get rolled forward or cash settled. Physical delivery is the exception, not the rule. But what happens when more people start demanding physical delivery? What happens when the industrial users who need actual metal start getting nervous about supply? What happens when investors lose faith in paper claims and want the real thing? You get a squeeze, and not the kind that resolves quickly. Look at what happened with nickel a few years back. The London Metal Exchange had to halt trading and cancel trades when a short squeeze threatened to bankrupt major participants. The paper market couldn't handle the demand for physical delivery. Silver is setting up for something similar but potentially much larger because the market is smaller and the supply deficit is structural, not temporary. Central banks are paying attention too. While gold gets all the headlines for central bank buying, silver is quietly being accumulated by nations looking to diversify reserves and secure industrial metals for strategic purposes. China, Russia, India. They're not just buying gold. They're positioning themselves in silver because they understand what's coming. The industrial demand story alone is compelling enough. But when you add the monetary aspect, it becomes explosive. Silver has been money for thousands of years. It's mentioned in the Bible, used in ancient Rome, formed the basis of currency systems throughout history. And unlike fiat currency, you can't print more of it. In an era of unprecedented monetary expansion, negative real interest rates, and currency debasement, hard assets are attracting capital. Gold has led the way, But silver offers something unique. It's both an industrial metal and a monetary metal. It has dual demand drivers that gold doesn't have. And here's the kicker. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of history, that ratio averaged somewhere between 15.1 and 30.1. Recently, it's been trading above 80.1, even hitting 100.1 during market stress. If that ratio reverts even partially toward historical norms, the implications for silver prices are staggering. Let's do the math. If gold is trading around $2,000 per ounce, and the gold to silver ratio moves to 50.1, that puts silver at $40. If it moves to 30.1, that's $66. And if it approaches the historical average of 15.1, we're talking about $133 per ounce. Now, I'm not predicting any specific price target, but I am pointing out that the current ratio is historically anomalous, and mean reversion is a powerful force in markets. The squeeze mechanics are already visible if you know where to look. Premiums on physical silver coins and bars have been elevated for months. Dealers are struggling to source inventory. Delivery times have stretched out. These are classic signs of a physical market that's tighter than the paper price suggests. And here's what makes this squeeze different from past episodes. In previous silver rallies, supply could eventually catch up. Mines could ramp production. Recycling could increase. Demand could moderate. But this time, the industrial demand is structural and growing. The supply constraints are real and persistent. And the investment demand is being driven by macro factors that aren't going away anytime soon. Think about the energy transition. Every solar panel requires silver. The push toward renewable energy isn't slowing down, it's accelerating. Governments worldwide have committed trillions to green energy infrastructure. Each megawatt of solar capacity requires significant silver content. As solar deployment scales, so does silver consumption. Electric vehicles are another massive demand driver. The average EV uses significantly more silver than a traditional combustion engine vehicle. With EV adoption projected to grow exponentially over the next decade, that's a huge new source of demand that didn't exist a generation ago. 5G networks require silver in their infrastructure. The Internet of Things, with billions of connected devices, all need silver in their circuitry. Medical applications, from antibacterial coatings to specialized equipment, consume silver. The list goes on and on. This isn't cyclical demand that rises and falls with the economy. This is secular demand driven by technological transformation. And it's happening at a time when supply is constrained and inventories are declining. Now, if you're sitting on retirement savings and watching all this unfold, you might be wondering how to position yourself. Because here's the thing about silver. It's not just for traders and speculators. It's a wealth preservation tool that's been used for millennia. Quick aside here. If you have $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're thinking about diversifying your retirement holdings beyond traditional stocks and bonds. Anyway, back to what's happening in the market right now. The institutional players are positioning themselves. Large investment funds have been accumulating silver exposure. Not through futures contracts that can be cash settled, but through physically backed ETFs and direct purchases of bullion. They're taking delivery. They're removing metal from the market. And they're doing it quietly, without fanfare, because they understand the supply dynamics. When institutions move into a market this size, the impact is magnified. The silver market is relatively small compared to gold or major currency markets. It doesn't take enormous capital flows to move prices significantly. And when those flows are directed toward physical metal rather than paper contracts, the squeeze intensifies. Look at what happened in the past when silver squeezed. In 1980, the Hunt brothers tried to corner the silver market. Prices spiked to $50 per ounce before collapsing. But that was a manipulation, an artificial squeeze that couldn't be sustained. This is different. This is organic demand meeting constrained supply in a market that's fundamentally tight. In 2011, silver rallied to nearly $50 again during the aftermath of the financial crisis. That move was driven by monetary concerns and investment demand, but industrial demand wasn't nearly as strong as it is today. the supply deficit wasn't as pronounced, and the move eventually reversed as investment demand cooled. What we're seeing now combines the best elements of both previous squeezes, but with stronger fundamentals. The monetary concerns are back, arguably stronger than ever given the scale of debt and money printing globally. But now we also have the industrial demand story, which is structural and growing. It's a one-two punch that the market hasn't seen before. The geopolitical dimension adds another layer. As tensions rise between major powers, strategic resources become increasingly important. Silver isn't just a financial asset. It's a critical industrial input for defense applications, technology infrastructure, and energy systems. Nations that control silver supplies have leverage. Nations that don't are vulnerable. We're seeing the early stages of resource nationalism in metals markets. Countries are restricting exports, building strategic reserves, and prioritizing domestic supply chains. This fragments the global market and makes supply even tighter for those without domestic sources. China dominates silver refining, processing a huge percentage of global supply. If trade tensions escalate or supply chains fragment further, that creates additional pressure on Western markets that depend on Chinese refining capacity. The just-in-time inventory systems that worked in a globalized world become vulnerabilities in a fragmented one. The paper market is showing cracks. Open interest in silver futures has been volatile. Large traders have been unwinding positions. The traditional market makers who provide liquidity are pulling back. These are signs of a market under stress, where the normal mechanisms that keep prices stable are breaking down. When a squeeze really takes hold, it can move faster than anyone expects. Prices that seemed stable can gap higher overnight. Physical premiums that were modest can explode. Delivery delays that were measured in weeks can stretch to months. And once the psychology shifts from silver is available to silver is scarce, the dynamics change completely. We saw a preview of this during the Reddit-driven silver squeeze attempt a few years back. Retail investors coordinated buying of physical silver and SLV shares. While that particular episode didn't trigger the massive squeeze some hoped for, it did reveal the fragility of the physical market. Dealers were overwhelmed. Premiums spiked. Mints couldn't keep up with demand. And that was just retail buying. Imagine what happens when institutions pile in. The current move in silver isn't being driven by Reddit forums or social media hype. It's being driven by fundamental supply and demand. The price is rising because the market is tight and getting tighter. And unlike a speculative bubble that can deflate quickly, a fundamentally driven squeeze can persist for years. Think about the copper market in the 2000s. As China industrialized, copper demand exploded. Supply couldn't keep up. Prices rose from under $1 per pound to over $4 and stayed elevated for years. That wasn't a bubble. That was a structural shift in supply and demand. Silver is setting up for something similar, but with the added dimension of monetary demand. The mining companies are benefiting, but they can't solve the supply problem quickly. It takes years to bring new mines online. Exploration, permitting, construction, ramp up. Even if silver prices stay elevated, the supply response is measured in years, not months. And many of the best deposits have already been found and mined. The easy silver is gone. Recycling can help on the margin, but it's not a game changer. Unlike gold, where most of the metal ever mined still exists in some form, silver gets consumed. Recovering silver from industrial applications is often uneconomical. The quantities are small, the recovery processes are complex, and the economics only work at very high prices. So we're left with a market where demand is growing, supply is constrained, inventories are declining, and the paper market is showing stress. That's the definition of a squeeze. And it's not a temporary phenomenon. The forces driving this are structural and persistent. For anyone holding physical silver right now, this is the scenario you've been waiting for. The market is finally recognizing the supply-demand imbalance. The price is adjusting to reflect reality, and the squeeze is just beginning. But here's what's crucial to understand. This isn't about trying to time the perfect exit. This isn't about trading in and out for quick gains. This is about recognizing that silver is fundamentally undervalued relative to its industrial importance, its monetary history, and its supply constraints. And that undervaluation is being corrected. The investors who do well in these situations are the ones who understand the fundamentals and have the conviction to hold through volatility. Because make no mistake, there will be volatility, there will be pullbacks, there will be moments of doubt, but the underlying trend is being driven by forces that aren't going away. The industrial demand for silver is only going to grow as the world electrifies and digitizes. The monetary demand for hard assets is only going to increase as fiat currencies are debased and debt levels become unsustainable. The supply constraints are only going to tighten as easy deposits are exhausted and political risks increase. This is a multi-year story. This is a structural shift, and if you're holding silver, you're positioned for it. The question isn't whether the squeeze is happening. The evidence is clear. The question is how far it goes and how long it lasts. And based on the fundamentals, we're still in the early innings. Watch the physical market. Watch the premiums. Watch the delivery times. Watch the inventory levels at the COMEX and other exchanges. These are the real indicators of supply tightness. The paper price can be manipulated in the short term, but the physical market doesn't lie. When dealers can't source metal, when premiums blow out, when delivery delays stretch to months, that's when you know the squeeze is intensifying. And we're already seeing those signs. They're subtle now, but they're there, and they're growing. The smart money is accumulating. The institutions are positioning. The industrial users are securing supply. And the retail investors who understand what's happening are holding tight. Because this isn't just another rally. This is the squeeze that's been building for years, the supply deficit that's been ignored, the industrial demand that's been underestimated, the monetary demand that's been dismissed. It's all coming together now. And if you're holding silver, you're on the right side of one of the most compelling supply-demand stories in the commodity markets. The squeeze is on. The fundamentals are undeniable, and the implications are massive. This is what we've been waiting for. This is the moment when the market finally recognizes reality, when the paper price catches up to the physical shortage, when the industrial users compete with investors for limited supply, when the squeeze that everyone talked about actually happens. And it's happening right now.